Hello and good afternoon, everyone. I'd like to welcome everyone on to this Succession and Ownership Strategies event this afternoon. It's great to host everyone today. Great to see everyone coming on. We've had really good response again to this event. We've got a good number of attendees, so that's great. So really pleased to have everyone on board. If anyone's got any technical issues at all throughout the event, please do feel free to contact us using the chat function. We are going to be having a question and answer session towards the end of the event too. So please do feel free to post your questions in the Q&A box as we go through, and we'll pick those questions up as we go through the event, and we'll be addressing those at the end. So on the panel this afternoon, we've got Joe Brewer, who's partner here at Oldfield, and we've got Jerry Surtees, who's Chartered Tax Advisor, and we've got Jack Bennett from the tax team, and we've also got Paul Turner from Watson Solicitors on the panel as well. This afternoon's event is really all about succession planning. It's about the passing on of the ownership and responsibility for the business down to the next generation of leaders. It's not often the top priority of a business owner. So, why are we talking about it this afternoon? Well, we think succession planning is really important because it's about securing the successful and sustainable future of the business, regardless of who is actually in charge or regardless of who actually owns the business. And it is a kind of sad fact that a third of family businesses don't actually make it to the second generation, and only 12% make it to the third generation, and just a tiny 3% actually make it to the fourth generation or beyond. So it's really important, thinking ahead for succession is critical for the survival of the business. And it's really important that the retiring generation think ahead early enough so that they don't cause inheritance tax problems, they don't cause damage to the business if other family members are expecting to get paid out of a share of the business. So if it's done right, it gives the retiring generation access to their capital and gives them a secure ongoing income. And it really frees up the next generation of leaders to take the business forward. And it minimizes the risks to the business from significant future unknown liabilities. So, you might already have had advice on succession planning. You might have, had some sessions where you talked about it. You might actually know what needs to happen, but this event is really all about the rubber hitting the road and actually doing it, flagging up the opportunities, flagging up the pitfalls from a tax and legal perspective and from a practical perspective. So before we go any further, I'm just going to quickly run through the agenda. So we're going to be going through this subject in the context of the different parties involved. So we're going to kick off by talking about succession from the perspective of the retiring generation. Then we're going to move on to the current leaders' perspective, the things they need to be thinking about, the opportunities and pitfalls for them. Then we're going to be talking about the future leaders, and we're going to be covering off on some of the practical legal aspects. And then we're going to summarize, wrap up, and address any questions that come up throughout the event. So I'm going to hand over to Joe, who's going to run through a real-life case study on succession planning, and then he's going to talk us through the retiring generation perspective. Thanks, Joe.
Thank you, Carl, and welcome to everyone joining this webinar this afternoon. Good to see so many attendees. It's excellent. So to kick off, I thought the best way to illustrate what we had in mind was by just running through a real case study, looking at what is best for the business and also the goals and priorities of each family member. So the particular business I had in mind was a client where there was aged parents in their 80s. They're still shareholders in the business, and they're obviously wanting to reduce their share after looking at all the options, they decided to gift just some of their shares to one of their sons. And this particular son was really the driver and CEO of the business. Another shareholder in the business wanted to realize some of their ownership in cash. They wanted to cash up some of their shares. And then there was another angle to it as well, the need to tie in a key employee by means of a shareholding in the company, retain and tie in that key person. So a restructure achieved a number of things. Firstly, gifting of shares from the parents to that shareholder who was really the responsible person in the business. That gave him a controlling shareholding to reflect his position in the business, so a shareholding of more than 51% in that case. It reduced the shareholding for the other family member, which was actually disproportionate to their level and input and responsibility, reduced their shareholding and gave them a cash payout. It also used company funds for the buyout, so that allowed them to release capital from the company, which was actually quite cash rich, at only 10% tax rate. And that's rather than the CEO, as we refer to him, having to find those funds personally to pay out and buy those shares. And then lastly, it added a key employee in as a shareholder in the business, which obviously does two things. One is it retains that employee and secures their long-term commitment to the business, but also is a way of obviously efficiently remunerating that person. And so you've actually got all three parties that Carl's referred to in that case study, the retiring, current and future leaders. So now we wanted to look at each party in this succession plan in a bit more detail, starting with retiring generation. And yeah, not quite sure why I've been picked for that, but yeah, there's obviously someone's got something in mind. They're choosing me as the speaker for the retiring generation. However, the retiring generation need to have a plan, and you really need to have a plan now, and it needs to be done tax efficiently. And I think there's thinking about it prior to this event, I think there's three key questions when you're passing down ownership and shares. Firstly, to who? Who are you going to pass those shares to? How are you going to do it? And when? So they're the three questions I think that come up. First question coming up is to who? So if you're an older generation shareholder, who do I pass my shares on to? Do I pass them on to other shareholders, to new incoming shareholders, or to a trust for the benefit of my whole family? Usually to who involves obviously moving shares around inevitably, and often perhaps maybe an older generation still retaining a small shareholding in the business, passing most of their shares down to a younger generation. That's something that regularly happens, and it really has to happen, actually, you know, to make sense. To gift some shares to a trust is also an excellent solution, and that obviously can be used to benefit, for example, grandchildren, including paying their school fees, and for numerous other uses. So the how do you pass on the shares? What's the fairest way of doing it? And another question that people ask is, will I lose all the value that I've built up in this company over many years? So every circumstance obviously different, and there's multiple options of achieving this. But you're either passing the shares on for no value, so you're gifting them, or you're realizing the cash out of the company tax efficiently. And this is something we're doing a lot of at the moment. So where someone says, yes, realize it's time now to reduce my shareholding, but I would actually like to quite like to realize some of that value of my capital. and the value of the shares that I've built up in this business. And I'd like to get my hands on some of that surplus cash that's in the company, that's building up in the company bank account. So why not? The key point there is you need a good professional advisor to enable you to do this. Obviously, normally when we draw money out of a company, we're paying higher rates of income tax or dividend tax or whatever. So we need a professional advice to be able to extract that money in the most tax efficient way. It's not exactly straightforward, but it's definitely achievable and also tax efficient if we get it right. So then the when question, when do you hand down majority control? I think we favour a staged process. So give careful consideration to what point you cease to be a majority shareholder. You need to be sure that the future shareholders have got the business acumen, and you might say the maturity, to be in a position of controlling ownership. So we feel it's best to start as early as possible, but make it a gradual, staged process. But don't leave it too late. I think that's a key point. We've seen that happen. We've seen an example of that was proprietors who are actually in their 80s, proprietors of a business in their 80s, founders and owners, still owning all the shares, even though their sons who were actually in the business were in their 50s, 40s and 50s, so kind of a little bit overdue there, thinking about succession planning. Finally woke up to it. But there you get a massive inheritance tax problem, amongst other obviously operational and practical challenges. You get a massive tax problem on your hands. Or too early. We've seen that as well with, if you start the succession planning process without properly planning it through and sensibly thinking of the implications. Saw a senior shareholder gifting away literally all his shares, leaving himself with no capital and no ongoing income, which is a kind of undesirable situation to be in. When the cash runs out, you've got no shares, got no income. So you need the security of an ongoing income. That's something that retiring shareholders are particularly concerned about, and rightly so. And just because you surrender some of your shares in the company doesn't mean that you have to, it doesn't mean that you can't still receive some sort of form of remuneration from the company tax efficiently. In fact, there's some excellent ways of still supporting the retiring generation with regular guaranteed income with only minimal ownership of the company. Finally, from me, I wanted to touch on something called the hidden liability. So think about that, the hidden liability in a business. This is something that business owners often overlook, and that is the risk to the business of this hidden liability. And by that, we mean older generation owning substantial shareholding. So if not planned for, and the worst was to happen, a significant older generation shareholder passes away, they will have built up quite considerable value in their shares, and this needs to be paid out to their estate. On them passing away, that would have to be paid out. Then there's significant directors' loan accounts often, and that's all deemed to be part of the estate, and that would need paying out to the estate, and then most likely to the rest of the family who could have no connection with the business at all. So the result of that means you're paying out of your company, and then this money is getting distributed elsewhere, obviously depending on what the will dictates. So the executors will have this job to do. The executors might be a firm of solicitors, or they might be family members, but in any case, they'll diligently seek to collect all that's due for that estate. And that could mean a huge payout for your company. So all of this, if not thought through in advance and planned for, means that the business is sitting on really quite a complex, costly time bomb, really. It's a kind of like a succession time bomb waiting to explode These huge payouts can literally wreck a business, in terms of cash. We've seen that happen. So estate planning, inheritance tax planning, and will writing is really a key part in all of this. So we'd like to raise a question with everyone on the call. Have you thought about inheritance tax consequences in relation to your assets in the business? It's not necessarily straightforward. Obviously, you need to have a thorough review of that. Inheritance tax is still actually one of the highest rates of tax in the UK. It's still 40%, which is one of the highest rates of tax. However, as we've said before, inheritance tax is really an optional tax. There's very few taxes that are optional. Inheritance tax is an optional tax, and by that we mean that you don't have to pay it if you plan ahead properly. There are ways of avoiding it. So in conclusion, I honestly fervently believe that if you address all of these points that we've talked about, you will have a more sustainable and stronger business. And I'll now hand over to Jerry Surtees, who's going to talk to us about current leaders. Thank you, Jerry.
Thanks, Joe. So what I wanted to talk about today was the job of the current leaders of the organisation, which is really, in this context, their job is to build what you might call a balanced ownership structure that's fit for purpose, not only for now, but also for the future as well. And also, importantly, keeps focus on the most important thing in the business, which is growing the business. And in our experience, it is really important to get this bit right and be prepared to have what might be sometimes difficult conversations. Because if you don't, the danger is that feelings of unfairness or what you might call imbalanced situations can fester and distract you from the most important shared goal of all, which is growing the business's sales and profits and building a sale-ready business. That's what we're all trying to do with our businesses. Someone said to me recently that fair isn't equal and equal isn't fair, which is an interesting expression, and it's often true in a business ownership context. We find that things work best where ownership proportions reflect the level of input and responsibility taken by each family member. Clearly, this is something that's going to change over time, and you also need to think about the direction of travel. In other words, perhaps the older generation stepping back, the younger generation coming forward, and in particular looking at your growth plans for the next 3 to 5 years, and who are the people that are really going to be driving that growth? Who are the people that are going to make that happen, if you like, and making sure that that is being reflected in the ownership and profit sharing. Another important thing to concept to grasp as well, I think, when you're looking at the whole question of ownership and profit sharing, is that there's a difference between what you might call remuneration for a role performed and your profit share based on your ownership and your investment in the business. So they're two quite distinct things. We're not necessarily talking about a salary being paid through the payroll. We're not necessarily talking about how it's structured for tax purposes, but just in the concept of it, you get an amount of money for a role that you perform in the business, and then as an owner, you also get a share of the profits over and above that as well. So that's just an important point to grasp. Where it is proving a challenge to get agreement on points, we'd always recommend getting your business advisors involved and if necessary, formal mediation, which we've seen work well in some situations. So having got to that point, you've got some broad agreement on the way forward. The next thing, as Carl touched on earlier, is making the rubber hit the road. We've got to actually do this. How are we going to structure it from a legal and tax point of view? And there are obviously a number of ways of doing this, depending on what the outcomes are that are looked for. But ultimately, I think you want a structure that achieves 4 things, which we've tried to illustrate on this slide as a overlapping circles. So we've got these 4 if you like, outcomes or priorities that we're trying to juggle all the time. One is the commercial outcomes. Clearly, this is a business. There's got to be some commerciality to what we're doing here, but there's also family outcomes as well, and different priorities for different family members, whether it's increased profit share or the ability to spend less time in the business, whatever it is. Different people have got different priorities that they want out of this. Then you've got the question of how it's done in a way that's flexible enough to make sure that all objectives are met and the different needs and scenarios are catered for, and also that it's tax efficient. And I think on that point, on those 2 points, you will find that there's a lot of advisors that tell you that what you might call commercial flexibility and tax efficiency are not compatible. They're kind of opposite ends, and you can't reconcile the two. You either have a commercial structure which isn't optimal for tax, or you have something that's very tax efficient, but it's kind of a bit of a straitjacket that you can't really do what you want to do because you're trying to be tax efficient. But we have found that in practice it's possible to achieve both objectives, something that's both flexible and tax efficient. On the tax side of things, there's a couple of points I wanted to mention in particular, just to mention. One is that where HMRC clearance is available, it's very important that you do get that. And don't just assume that because what you're doing is in your mind's kind of fairly straightforward, that HMRC will necessarily be happy with it. HMRC's kind of stance on granting clearance does seem to have changed a bit recently. Some might be aware of this, but we did have a recent situation where clearance was rejected on a very straightforward transaction for reasons which just did not stack up. Now, thankfully, we managed to write back to them and quoted relevant case law and so on, and thankfully they changed their minds. But it does just emphasise the point that increasing care is needed in that area. The other point I wanted to mention as well, which we've mentioned before in other contexts, is the question of stamp duty on shares. Some would be aware that stamp duty applies to shares as well as property. So wherever you're talking about moving shares around in a company structure, you've got to think about stamp duty as well. That is at times a hidden cost that can sometimes be kind of sprung on you at the last minute. Oh, by the way, there's this stamp duty bill to pay as well. Hope you don't mind, sort of thing. So watch out for that, but also don't just assume that it is a necessary cost. In some cases, it's possible to effectively design that out of the structure, so it's a cost that doesn't have to be paid necessarily. So kind of in summary, what you need is advisors that can help you achieve all of the above, all of those kind of four concentric, all of those four circles. We're looking to try and aim for the overlapping bit in the middle, if you like. And in our experience, that is possible to do. These are not mutually exclusive outcomes. And as we said at the beginning, the key is that we keep focused on growing the business. And to do that, we need the foundation of a well-designed structure that meets those four objectives. So with that, I'll hand you over to Jack, who's going to talk about future leaders. Thanks, Joe.
Thanks, Joe. That's good. I think when considering the future leaders of the business, the key point to think about is, who do you consider to be critical to the future success of the business? Who is the business relying on, or who will the business rely on in the future? And as Joe's example earlier showed, that can be family members, but it can also be employees. There could be some senior employees that are vital to the business's success in the future. And in reality, that does often crop up. We do see it a lot where businesses, the owners realise that they are quite dependent on key employees. And a well-proven method for both retention and incentivization is to give that employee a shareholding in the company, so that as they put their effort in, help make the business grow in value, they're also building up their own personal equity at the same time. And there are a number of different ways of bringing employees in as shareholders, and each situation really requires specific consideration. There isn't a one size fits all approach to this. It has to be carefully analysed as to your personal situation, what you want to achieve for your circumstances. And often the tax consequences of a wrong decision or doing something the wrong way can be quite significant, both for the employer and also for the employee. But bringing employees into share ownership is really quite a subject in itself. And we are anticipating that this will hopefully be a subject of another event in the future. So look out for further information on that. The other scenario that often arises in family-owned businesses particularly is where the current leaders want to help their children to benefit from the company in a tax-efficient manner. So it might be helping them to build up funds for a deposit for a house or for paying off some loans or whatever the situation might be. It varies a bit, but a common mistake is to bring the children in as shareholders and directors prematurely. So they might have only been in the company for 12, 18 months, and they're not really in a position where they are key or vital to driving the business forward. Obviously, in the future, you hope they will be, but they might not be at that stage yet. And that's really a wrong time to bring them in. You need to bring them in when they are going to help the growth of the company. But one solution we've found works well in this circumstance is to use a welfare trust as a means to top up the child's income. So they might be earning a commercial salary based on the work they're doing, and you can top them up, help them still achieve that aim of helping them to build themselves up financially. But then you leave bringing them in as a shareholder and director until it's a commercially justifiable decision. And the final point to consider in terms of regarding future leaders is to really review your business in advance in terms of different departments or different silos. You might have a couple of different departments in your business, perhaps doing slightly different products, different sectors. And really, it's a good thing for the business owners to do. So review your business and see where you want it to be in 3 to 5 years' time. Look at your business model and consider whether it be worth splitting out different departments of your business, and consider whether you would have different future leaders for different departments. Often with that kind of thing, it's better to anticipate this well in advance and be prepared and be ready for it. The tax consequences are often much better than suddenly realizing too late that actually these are different businesses and we need to split them now. So I think that's really my key points on the future leaders. Just make sure planning in advance is the key point. Make sure you know roughly where you want to head. And with that, hand over to Paul Turner to give us some guidance on the legal aspects. Thanks, Paul.
Thank you, Jack. So I'd like to look at a number of legal aspects. The first one tags on to the issue of giving shares in the company to employees. So as a family business, they may not have given shares to employees before, and it does raise a number of questions. Now, first off, you'll be thinking, how much equity do we want to give away? And there's obviously commercial drivers for that, and that can be structured in a number of ways to achieve your goal so that everyone keeps what they want to keep, but gives enough so that there's an incentive and a reward there for the employee. You've also then got to ask, what's the employee, are they buying into the company with this and, putting some skin in the game, so to speak, or are they being gifted this shareholding either in recognition of past achievements or as a pure incentive going forwards? But the big question that always crops up is, what happens if we give shares to an employee and the employee then leaves, either in 6 months or in 6 years? Where does that leave us as a family business? And this is where it's really, really important that when the employee shareholder comes on board, you have the proper documentation in place to govern that shareholding. The reason for this is that in the absence of documentation governing that situation, unfortunately, the law doesn't protect you. So there's no statutory right or common law right that gives you as a family member or as a company the right to buy that employee's shares back in the event they leave. And actually, played out in a scenario. We were asked to advise on the sale of a company, probably going back about 2 years now, where it's a family company, but one of the shareholders was a non-family member employee, or a person who had been an employee, but they'd actually ceased to be an employee probably about 18 months before the sale took place. That person left employment, there was friction between the two, and the employee simply refused to give up their shares in the company. The company and the family members then not having the documentation that they needed in place, had no right to force the employee to give up their shares. What that meant when they came to sell was that the employee got to participate in that sale at the same time as the family members. And as a buyer of the company, interested in they didn't want to buy 95%, they want to buy 100%. So they need the employee's shares as well, which gives the employee a lot of leverage in that scenario to say, here's the price I want for my shares, otherwise I can scupper your deal. So the way that played out, and the employee got, I suppose, what their 5% shareholding was worth at the time of sale. The extra, I suppose, bitter bit for the family, if you like, is that shareholding in those final 18 months between the employee leaving and the time of that sale had increased quite significantly. So had they bought them out 18 months earlier, the price would have been a fraction of what they ended up paying this employee in the first place. Now, play that same scenario with the proper legal documentation in place, and the family or the company, whoever was best placed to do so, would have been able to buy that employee's shares at the time they left employment, so that they no longer hold any shares. And in most instances, it's circumstantial, but in most instances, they can be bought back for a relatively nominal amount as well. The other aspects I want to briefly touch on from a legal side is how, like, a common shareholders agreement can help families with their succession process. So the shareholders agreement will typically cover, set out, I suppose it's the document that links the family arrangements to the shareholding arrangements. So it sets out some values and also expectations with what's going to happen between the family's interest in the company as time moves on. So things like what happens to an individual's shares in the event they're taken, or can shares be freely sold by family members, and if so, who to? Can they go to only other family members, or can they go to an outsider? What level of control and influence does each person have in the business and its affairs, and does that have to be proportionate to their shareholdings? And there's lots of other questions and things that you could cover off in a shareholders agreement to help with the succession, but I just want to touch on that last one a bit more. So how can a shareholders agreement help succession where a shareholder wants to step back from the business, to reduce their shareholding, but retain some level of kind of influence and control over the business, so that they are comfortable handing over the reins? And as we've touched on, this transition from senior generation to more junior generation is a process, and it will happen in phases. So very rarely does an outgoing shareholder say, I want to go from shareholding here to here, and overnight everything else goes from here to here in the business. So responsibility shifts and decision-making shifts and so on. So a shareholders agreement is a great place, a great tool to help with this, because it allows a shareholder to reduce their shareholding, but stay involved in the decision-making process. And they could have a casting vote, or they could have a special position on the board, or they could have a list of requirements that they have to be consulted on or even consent to before those events can occur. So it hands over the baton to the younger generation, but within pre-agreed parameters with which the senior generation are comfortable. And we've seen this work out really well for lots and lots of clients, actually, where there's been some hesitancy in handing over the baton to the younger generation, perhaps because, I don't know, family structure, makeup, so it means that they aren't quite at the level where they're comfortable completely letting go, and there needs to be a bit more maturity or nurturing. Many other reasons too, but it allows that transition to happen, so the younger generation can take their shares at the time that they feel their responsibility is growing, so they're feeling involved and rewarded in the business. But equally, the senior generation are still there in oversight, so they're all of the value that they've built up in that business over the years, they get some control over that, and they can aid the transition and make sure it goes smoothly. I think that's all I'll cover for now. Carl, back to you for Q&A, I believe.
Thanks so much, Paul. Yeah, so just before we move on to the Q&As, just to summarize really quickly what we've talked about. The overall message is that succession planning is not just a once in a lifetime event. It's not something that happens once. And it's not something that should be put off to the last minute. It should be a continuous process, and it might need multiple gradual stages to make it work out in view of the sustainable success of the business. So we're saying don't leave it too late. We're saying that we really recommend that you start thinking about it now, and that you start on the first steps in that journey now, do something about it, and perhaps keep it under review, maybe review it at least once every 2 years, make sure your plan is up to date and relevant for what's going on. So I just thought it'd be good to just give you an idea of the process that we're working through with a lot of our clients when it comes to succession planning. The first step in the process is always getting more awareness, and obviously today helps with that. We're giving you ideas, we're giving you insight into the opportunities and the pitfalls and practical key points. So that's today, if you like. The second step in the process for our clients typically is having a succession and structure consultation. And that's really where we sort of review your current structure and make sure it is robust and tax efficient. Look at your future plans and look at how best to achieve those, how to get the rubber to hit the road, so to speak. And we make recommendations on how best to structure the succession from a tax and an asset protection and structure perspective. And that then gives you a clear documented roadmap that everyone can agree to in terms of, what are we going to do and when. And obviously point 4 is actually executing that roadmap, actually making it happen, doing whatever's necessary, getting the HMRC clearances, doing the legal documentation, etc., to actually make the thing happen. So, you've got more awareness today, step 1. If you do want to take it to step 2, if you do want to take it to the next step where we actually have succession and structure consultation, look at the whole situation, then you can register your interest for that on the email coming after this event. And I'm also going to just drop a link in the chat box. So, if you are interested in taking it to the next step, you can just click on that link and register interest. And what we'll do is we'll have a follow-up call, no obligation at that stage, but just to talk about the situation, talk about actually having a succession and structure consultation. So we're going to move on to the questions. We've had questions coming through. So let's have a look at these questions. So, okay, the question we've got here, you've said the message is don't leave it too late. When is the right time to start on succession planning? Joe, have you got some thoughts on that one?
Yeah, thanks, Carl. Probably quite a challenging question, isn't it? Really, kind of. There's another question as well. What age is the right age to start? That says similar question. all those two into one. Yeah, I don't know. We can exactly categorically say what is the right time or when is the right time to start. All I know is that we're actually talking a couple of days ago, and we were saying the right time to have done this was about 5 to 10 years ago. And this is what clients are often saying to us: wish I'd thought about this earlier, wish I'd done this 5 years ago, 10 years ago. So I think that's the point of today's session, is the right time to start thinking about it and planning for it is really now. And bear in mind the gradual and staged approach to it. So you might say, well, the final outcome really is for this one shareholder to be out of the business completely, or whatever the outcome may be that you've got in mind in your particular scenario. I think the right time to think about it is now, and maybe a staged approach. So by doing it in stages, it kind of smooths the way, smooths the path, possibly makes a smaller, payout, and also is a better outcome for everyone. But I don't know what you'd say on that, Jerry. Can you add to that?
Yeah, no, I think that's right. I think you're right to kind of, if you like, hesitate to be too definite about laying down a definite age. If you like, you start thinking about it. I suppose a couple of parameters just to kind of add to what you're saying is that I suppose one thing would be to look at the next generation of leaders in the organisation, who they're going to be, and what age they're at and what stage they're at. Clearly, talking about succession planning when they're perhaps still in their teens or only just left school probably isn't the right time to do it. You're going to want to wait until they're at least, let's say, into their 20s and taking some responsibility. So that would be one thing. And then kind of at the other end of the spectrum, from an inheritance tax and estate planning point of view, it's wise not to leave it any later than, let's say, your early to mid 60s, because once you get beyond that, your options in terms of inheritance tax planning and estate planning are starting to become more limited. So on the rules of average life expectancy, if you like. So I would say that would be, you wouldn't want to leave it any later than that, ideally. I don't know if that helps.
Thanks, Jerry. And Joe earlier spoke about the retiring generation gifting some of their shares for the benefit of the whole family into a trust. And I've got just a question here. Is that gifting shares into a welfare trust? Is that what you're thinking, Joe?
Yes, that's right. To have a trust in your structure that would benefit the whole family. And we obviously developed that unique product, which we call the welfare trust, or well-being trust, which is really for the welfare, for use in wider cases. You can use it more widely for the benefit of others that you know of that are in need. But the principal use of it is actually good tax planning to help grandchildren, isn't it? If you gift shares into that trust, your grandchildren can benefit, be recipients and beneficiaries of the trust. You can use it for paying school fees, for savings for them, like Jack touched on already. But that's, yes, certainly not what I had in mind, Carl.
And just sort of off the back of that, could you then use that trust to top up an employed family member's pay? That was another question. And Jerry, did you have some comments on that?
Yeah, so normally we're very cautious about employees and doing things with trusts, but I think whereas a family member, it can be demonstrated that there's a family link involved. So provided, I think what we normally say is provided the employee's pay is commercial for the role they're doing. So say it's a younger family member who's just out of school, and their commercial salary is perhaps relatively low, then you can top up using the welfare trust, and that works well in family situations.
Good, that's clear. Another question here: if, as an older retiring shareholder generation, if I pass my shares on to others, and hence lose dividend income, can I still draw a substantial salary, even though I'm not doing much for the business? Interesting question there. I don't know, Jerry, what your comments are on that?
Yeah, well, I'm sure I don't need to answer all the questions, but I think the answer to that is making sure that you build. Going back to the point that we were talking about flexibility, you need to build a flexible structure, and in particular a flexible share structure that allows you to take that income out without necessarily needing to have a particular or a significant size of shareholding. And we tend to prefer to do it that way rather than paying people large salaries, which isn't terribly tax efficient.
That's good. And another question here, when referring to shareholders and talking about succession, do the same principles apply to a partnership? Joe, have you got any thoughts on that one?
Yeah, that's a really good question. Obviously, it's a different type of entity. You don't have shareholding in a partnership, but in the principle of succession planning and going through this process certainly applies. And I think you arrive at the same outcome in a partnership by having regular reviews of the partnership agreement and obviously mutual agreement as to how the profits are shared, how the goodwill would be shared, and how ultimately the business sale would be shared between the different partners based on often three things really. One is the level of input partners are giving to the organization, maybe the length of time and the amount of capital they've got in the business, and then thirdly, obviously, depending on what their needs are as well. So there's a number of situations there, but in principle, yes, succession planning applies to partnership, doesn't it? But the mechanism is different. It's more to do with partnership agreement than actual shareholding.
Good, thanks for that, Joe. Question here, probably for Paul. Can a shareholder transfer their shares to whoever they want to? What do you say on that one, Paul?
So in the absence of any legal document saying otherwise, then yes, they can, which is one of the reasons why we'd always recommend a shareholders agreement if a particular client comes to us and they haven't got one in place. Even if it's the healthiest family in the world and there's never going to be an issue, just documenting it for that one purpose alone, because inevitably there will have to become a share transfer. It might not be a voluntary one. It could be when someone's taken, their shareholding then passes, say, under a will, and you've then got a situation where we've touched on it in, I suppose, implicitly in other ways, but if their shareholding's left to a minor, someone who's under 18 or someone who perhaps isn't ready to step into that capacity as a shareholder just yet, if you plan for that ahead of time, the family can agree, if that situation arises, how would we like it to play out? And then you can involve things like trusts, or the shareholding should go here and here instead of to this other person, and so on.
Good, that's helpful clarification there. Just got another question here. If a retiring member gifts their shares directly to another shareholder, is there a capital gains tax liability, and what happens about the inheritance tax on that? Jerry, you probably do want to answer that one.
Yeah, so I think you're right to flag those 2 points up. They are two key points when you're talking about succession planning. capital gains tax and inheritance tax would be the two sort of key considerations, really. And the tax liability is dictated by how it's done. So if it's a straight gift, usually you can structure that so that there's no tax implications. Not necessarily, not automatically. And also potentially there might even be better ways of doing it than just gifting, which allows the retiring shareholder to realise or release some of their capital out of the company at the same time. So that's a bit of a it depends sort of answer, but I don't know if that helps.
I think that's a key point, Jerry. I always used to think that yeah, there were two ways of actually doing this. One is to gift your shares, and the other is to sell them. But there's actually other ways of doing it, isn't there, which are actually more tax efficient. So I think the answer to that question is, yeah, need to look at the other options as well to be maximise on the tax efficiency, isn't it?
Yeah, that's good.
Another question here. I think this one's for you, Paul. Does a shareholders agreement need to be an actual legal document, or is it just a signed agreement on paper between the shareholders? Or what actually makes it legal?
I wouldn't attempt to write one yourself, would be my short answer to it. I think, yes, it's a written agreement, and what makes it legal is simply that it is in writing and signed by everybody. But because of the way, when you're dealing with a share structure from a legal perspective, you've got a number of documents. You've got a shareholders agreement. You've then got what we call articles of association, which is your company's constitution and sets out the share rights. They need to work in parallel. If they don't, and they're not designed to work together, you've created a messy situation, really, where one thing says this should happen and another says something else. And also, I suppose, as lawyers over the years, you come across the scenarios that need to be addressed in these types of documents. So we're in a position to ask the right questions when putting a shareholders agreement in place, so that all the bases are covered.
I think as well, to add to that, Paul, as well, is that we've seen situations, you'd be familiar with the kind of thing I'm talking about, where shareholders agreements or partnership agreements are drafted in a way which actually is very, very detrimental from an inheritance tax perspective. And you could unwittingly put yourself in a very, very vulnerable position for inheritance tax purposes. So we certainly wouldn't recommend doing it yourself.
That's a very good point, because you could have two documents that try and achieve the same practical objective, but the nuance in the drafting can mean that a totally different tax treatment is achieved. So you might get to the same practical scenario and the shares land with Mr. Smith, which is where they're meant to be, but he's got to pay a fortune of tax on it now because you got one sentence written slightly differently in your agreement.
Thanks. Thanks, Paul and Jerry. I think that's good. That's clear. Good. Just perhaps one last question before we wrap up. Jerry, you mentioned about pay for doing a job versus profit share or versus return on investment. How do you determine what that sort of right level of remuneration is for the role performed?
Yeah, that's another one of those difficult questions. I think when we're talking about directors, the kind of starting point, kind of rule of thumb that we tend to often work to is 80,000 per director. Now that depends a little bit sometimes on the size of the business concerned, but that's a good rule of thumb kind of starting point. But I think the key sort of principle that we're trying to arrive at is that you agree a fixed salary element or profit share, if you like, that comes out first for everyone's role that they perform in the business. And it might be pro rata to, for example, the amount of time they put into the business, the number of days they work. And then once you've taken that out, you're then saying, well, okay, how are we going to share all of these, the remaining profits out? What are the proportion share profit shares between the different family members. Does that answer the question?
Yeah, thanks, Jerry. I think there was just one other question that we wanted to address before we close up. That was just, Joe, in relation to what you were talking about the hidden liability and having to pay out other family members without kind of realizing it. How do we find out if that would be the case?
Yeah, that's a very good question. Probably best illustrated in another case study really briefly. We came across a business recently where there was like a father and son shareholders of the business, and father owned the majority of the shares, and then obviously he's in his 70s, I believe. So the question then is, the business, the son was sort of totally unaware of the kind of threats, the continuation of that business. If something were to happen and father were to pass away, what would actually happen? And so, well, that you'd have to value the shares, the commercial value. You'd have to pay that out to the estate. Have you got any sisters or brothers? And as it happened, this particular person had got three other siblings. So yeah, the potential there is that, let's say the father's share was worth £1 million. That £1 million would have to be paid to the estate, and then the son, assuming they were all left equal shares, would only get a quarter of that. So that means he had a £750,000 payout to the rest of the family that he was just totally unaware of. And yeah, how do you find it out? Well, I don't know, use a bit of wisdom and do a bit of digging, find out what the situation is. But it is a matter that does need to be addressed. You cannot have the future of your business under question because of something you're unaware of. It wouldn't be fair on the employees working that business or the other stakeholders. That's all I was thinking on that one, Carl.
That's good. Thanks for that, Joe. Good. So I think that brings us to the close on the questions. And that brings us to the close of the event. So we'd like to thank everyone again for joining us this afternoon. It's been great to host you, and we look forward to speaking to you again soon. Thank you very much.